I'm going to talk to you about this book, The Little Book That Makes You Rich, by Louis Navellier. I think that's how it's pronounced. As you can see, I have a picture of the book on my PDF. I took that picture off of the internet somewhere, I don't know where, but I think this method of making videos is better for you, better for me. If you've seen my old videos, I do them a little differently, but I like this method more so far. All right, so I sum this book up to 8 steps, and the author lists those in the book. These are 8 tried and true, key fundamental factors that drive stellar stock price performance and have stood the test of time. There's a lot more to this little book, but I could narrow it down to these 8 fundamental factors, really. There's not much to it. It's not a very big book. It's not very long. And if you know anything about stocks, a lot of the information will be redundant. All right, so let's start with the first one. Number 1, positive earnings revisions. When Wall Street analysts indicate that a business is even better than anticipated. So this blue graph, whatever it is, this is the Wall Street analysts version. This is what they predicted. But the red is the revised version. And this is what happened, you see. So the earnings were a lot higher than they had originally anticipated. That's all that means. 2, positive earnings surprises. Announce corporate earnings that are higher than analysts expected. So let's start with Occidental Petroleum Company. The year to date was 52.5% in earnings, but this earnings surprise knocked it up to 1,102%. That's a huge difference between 52% and this. We'll just look at another one. Caesars Entertainment Company, year to date, 21.9%, and then the earnings surprise was 438%. You can see what that means here. All right, so number 3, increasing sales growth. Continuous, rapid sales growth of a company's products. That's pretty self-explanatory. The company is doing well. Sales are rising. There's not much to say about that one. Number 4, expanding operating margins. Corporate profit margins that are expanding. This is pretty self-explanatory too. Surplus must grow, reserves must grow, investments must grow, and so forth. 5, strong cash flow. A company's ability to generate free cash flow after expenses. So this is after everybody's been paid, after the government has taken their share. This is what is left over, the cash flow. They say that it doesn't really, in some cases, it doesn't really matter what you earn, it's what you keep. You could have somebody who earns $50,000 a year and another person who earns $100,000 a year, but the $50,000 a year person is able to keep their cash or keep a lot more after they've paid their bills. But the $100,000 person is in debt and has no money left over. So who is the more successful one? I believe the $50,000 one, but that's just me. 6, earnings growth. Sustained earnings growth quarter to quarter. And this is self-explanatory too. So every quarter, this company is growing. Even if it's just a little, they're still growing, as you can see in this chart. 7, positive earnings momentum. Earnings that are accelerating year over year. And so earnings keep going up and up and up and up. And they keep rising every year. I'm assuming probably Apple is like this. 8, high return on equity, high overall corporate profitability. So people want to invest in this company because they're earning money and they get a return on their investment, and everybody's happy. In addition to these fundamentals, the author says, invest in growth stocks. These produce capital gains rather than income. And Wall Street sells stories. The better a story sounds, the more you should beware. Storytelling leads investors down a path of underperformance and losses. The dot-com boom is an example of this, people believe that they had to lose money in order to get this great fortune at the end, and it didn't happen. And as for this one, growth stocks, you just want to invest in companies that just keep growing, where their momentum is rising, even if it's a little bit each year, but it keeps rising. Numbers don't have emotions, but people do. You can show love to stocks, but stocks can't love you back. When they become too risky, you have to sell them and move on. A lot of people didn't, I think a lot of people got attached to the numbers during the real estate boom that was going on. I think it was around 2007. And they didn't see what lied ahead, that this was a bubble and it was about to burst. And it did. Analysts issue estimates or educated guesses. If an analyst guesses too high and if the stock drops, they lose their job. But if the stock rises, no one cares if they were wrong. So it's just educated guessing. Free cash flow gives a company a lot of flexibility in its decision making. They can work on new projects, they can expand the company, and so forth. And the stock market is schizophrenic. Look at this. Oh my God. That is crazy. And you can screen for stocks by using websites like Yahoo Finance, CNN Money, and MSN. I think Yahoo is probably good for finance, but not news. And same thing with CNN. But just don't go to them for news, at least. I mean, you can if you want, but it's just, I wouldn't. They're biased. But so is Fox News and a lot of others. Well, anyway, that's all I wanted to talk about. And I hope you got something out of this. You can see these are my slides. And that's it. Thank you for watching. Bye.